everyone, and welcome to this special webcast with two of the best economists, bond market gurus, and policy experts on the planet, Lacy Hunt and Gary Shilling. Quick one anyway. Lacy is the Executive Vice President and Chief Economist at Hoisington Investment Management. He's the author of a whole slew of important books on economics, his best known being, in quotes, A Time to Be Rich, Winning on Wall Street in the New Economy, end quotes. And another one that is a bestseller in my books, which was titled Dynamics of Forecasting Financial Cycles, Theory, Technique, and Implementation. Lacy is a constant and important voice on markets and investing in the popular press. And as one of his many rightful acknowledgments of his role as a very important voice, he is the recipient of the prestigious Abramson Award from the U.S. National Association of Business Economists for, I quote, yet again, outstanding contributions in the fields of business economics. Now on to Gary Shilling. Gary, also a very special guest. He is president of A. Gary Shilling and Company. That is an investment advisory economic consultant firm. He has published for many years, many decades, a brilliant monthly report called Insight, with his economic forecasts, his policy prognostications, and his investment strategies. It has been a must-read for a very long period of time. And Gary, along with so many of his accomplishments, has also published 8 books on the economy and on investment strategy. And in the spare time, whenever he gets any, he is America's most noteworthy beekeeper. So he's part of the A team, but he works with bees. Both Gary and Lacy and I, we go back a long way. And I'd say that if there is a core competency we share, it's on Fed policy, the direction of interest rates in general, and the bond market. The structure of this webcast, because it is a panel, is that I'm going to have Lacy start off with his so-called worldview, and then we'll turn the mic over to Gary. I promise to keep my interruptions and interventions to a minimum. And after Gary is done, we'll open it up for a healthy debate and fireside chat. Throughout, feel free as usual to send in your questions, and if we don't get to all of them here on the call, we will be sure to follow up with you over email in the next few days. So, with that, Lacy Hunt, over to you, sir.
Thank you. You're too kind, Dave. It's a great pleasure to be on this panel with you and Gary. As you said, we all have relationships with each other, and they go back a long way. With regard to the worldview, I want to start with U.S. fiscal policy because I think that is at a very critical juncture in U.S. economic history. We're in the midst now of making an important and fundamental change from the handout economy to the hand-up economy. The hand-up economy emphasizes incentivizing people to work harder and longer and be more creative and by increasing their after-tax rates of return. We're getting away from the growth of massive increases in government spending. And this distinction is critically important because the way in which hand out versus hand up affects things is considerably different. Over the short run, when government is expanding very rapidly, there is a boost to economic activity. Unfortunately, as time goes by, that effect reverses itself. And at the end of the day, the economy is overburdened with debt and it considerably underperforms. The U.S. is falling well below its trend rate of growth, and the situation in Europe and Japan and the U.K. is even worse. Current performance versus what historically has happened. So the hand-up economy has already accomplished an important objective. It slowed almost immediately from the massive increase in government in the fourth quarter to a much slower pace right here, triply through executive actions and so forth. And the legislation will occur later, and it will occur at the same time that the tax rates are, the current tax cuts that were enacted in the first Trump administration will be extended and will be additional incentives added. But the point is that this leaves a gap in the degree of government support that the economy is getting, because the screeching to a halt of the government expansion will be a retardant. It's a short-term effect, but its reduction will be positive over the longer term. The tax reductions will work in due course, but they will take time. For example, if you go back and look at the Reagan tax cuts of the early 1980s, the economy began to make progress, but it was very slow and unsteady. And it really didn't kick into high gear until 87, 88, 6 years. There's also an important difference between the early 80s and now. The economy at the time was at a cyclical trough, a deep cyclical trough. And there had been massive correction in the stock market. And also fiscal policy was being abated by a judicious increase in the monetary aggregates. And so there is a gap that's looming here in the first quarter already because of the handoff. The handoff is essential, but in the short run, there is going to be a bumpy road. Now I want to talk about monetary policy. Last year, as a lot of folks have noted, M2 in nominal dollars increased by about 2.9%. And following Friedman, people say that this is significant. And by the way, notice that the inflation rate has kind of stopped its fall. Money's increased, the inflation rate has stalled out, maybe even inched up a little bit in the fourth quarter. And so the Fed was premature. Well, let's talk about this. This is a very important issue. Friedman was a great economist. There's no question about it. I've learned more from Friedman than anyone else, practically. I have great admiration for him. But we have to remember that Friedman completed his theoretical work in the mid-1980s. That was 4 decades ago. And economics is a science, it's a social science. And because of that, we get additional information, we get additional concepts, we can expand our hypothesis testing. And I think that there are important changes that are necessary based on all of this additional information that we have acquired in the 44 decades since Friedman concluded his is significant research. The first is that the money supply should be stated in real terms. Now, when Friedman was active, there was another very brilliant economist, also with a PhD from the University of Chicago, and his name was Don Patinkin. And he wrote a book called The Real Money Balance Effect in the mid-1950s. And now, Patinkin's approach was different. He was looking at general equilibrium analysis. And he was following in the footsteps of Walras, a famous Italian economist who introduced Walrasian economics. And Patinkin gave substantial evidence that the money supply should be deflated and put in real terms. Friedman won the debate. I myself, back in those days, vacillated whether it was a better idea to use nominal or real monetary growth. But I think that this additional 4 decades makes it clear that money supply should be deflated. We don't use nominal GDP. That's not the focus of policy. It's real GDP. And so, based on the arguments that Patinkin made, it needs to be deflated. But there are 2 other changes that I think that time requires that we make the adjustment to the Friedman model. And that is that the cyclicity of the money supply has increased greatly. Friedman was well aware of its cyclicity. In fact, it was its cyclicity and its relationship to economic activity that Friedman was able to attract so many supporters of the monetary economics that he was advocating. But I think, and I hope people will check this out, the money supply in real terms needs to be corrected for the trend rate of growth that is occurring. You need to take out the trend factors after you have adjusted to real dollars. And the 2 critical trend factors are the money supply growth itself and also the velocity of money. And you have to take both of them into consideration. And the reason that you need to include velocity is that when Friedman was writing, and his historical research captured a time period from the late 1940s through the early 1980s, when the velocity of money was stable. And Friedman's propositions were based on the concept that we would have a stable velocity of money, and it's not. It's become extremely unhinged since the mid-1980s. So the solution to get the best reading of the monetary thrust is to look at money in real detrended terms. Now, there's one other thing that's quite important that we have learned as a result of what happened during the pandemic. We had this massive explosion in money growth. And we only had one other sustained massive change in money supply, and it was to the downside, and it was in the Great Depression. And when you had the collapse of money growth in the recession, it took a long time for the economy to recover. But we only had that one data point, the 1930s. Now, as a result of the pandemic, we have a second data point, which is the pandemic surge of money supply. And so, looking at this broad sweep, I think that there is another important corollary, And that is that if money supply goes way outside its bounds, its normal bounds, then it takes a longer period of time for the economy to recover. Couldn't draw that conclusion based on the 1930s alone, but now we have a second point, and it suggests that real detrended money is affected by the degree of deviation from the norm when money supply is extremely fast or extremely slow. And Friedman, one of his famous phrases was that monetary policy works with long and variable lags. But in the current situation, we're dealing with a longer lag because of the explosion in money growth in 20 and 21 and the first half of 22. So here's my point. When you make the adjustments that I've just talked about, the best monetary period is 4 years. It's not 2. It's really longer. And so we conducted some tests and looking at the different lags, and on a real detrended basis, the best lag in the current environment is a 4-year lag in the U.S. And we also tested this relationship for the United Kingdom, Japan, China, and the EU. And what did we find? We also found that the optimum lag was 4 years. And so when people cite the uptick in M2 growth last year in nominal terms, it is true that it's happening, but it may be of little value or information. And the 4-year detrended real M2 growth is negative in the United States still, which means that the full extent of the monetary restraint is not yet fully in the economy. Moreover, I constructed an aggregate, a weighted aggregate of global money supply for the US and 5 other major regions, the EU, the UK, Japan, and China, and that's also declining on a 4-year basis. So, with regard to monetary and fiscal policy, we have a gap in terms of the handout from the handout economy to the hand up economy, and monetary policy is still restrictive. And I don't believe that Chairman Powell has any awareness of what I've done, but even by his calculations in the latest press conference, he said that monetary policy was restrictive, and which means that the powerful stimulus on both the monetary and fiscal fronts still in the economy, but the action to remove them is there and in place. And when the changes are made, they're not going to work quickly. This is going to be a long, slow, hard fight. At the end of the day, based on the research that I've done, I think that we will all be better off, and particularly our modest and moderate income households that have been absolutely clobbered by the mix of policies that the country has followed. Now, I want to address one final thing, and that is the notion that tariffs are inflationary. Now, a lot of people studied Econ 101. And I know this because when I give talks and go out amongst conferences and so forth, a lot of people start talking to me by saying, based on my old Econ 101 class, this or that. But the fact of the measure is that Econ 101 class long ago has been surpassed by the increase of knowledge that occurs over time. Now, one of the great contributions to economics was the law of comparative advantage from the great British economist, David Ricardo, who probably did more for economics than any other economist, including Adam Smith. And he showed that if you bring countries together and one country has the lowest absolute cost, there can still be profitable trade, because what is critical is the marginal cost. And if you do that, then trade will increase, the standard of living will rise, and you will have an efficient distribution of goods and services and lower inflation. And we all learned that. However, what was not learned is that the Ricardian model works if the system operates under Adam Smith's invisible hand. In other words, you cannot have mercantilist exertion into the process, because in that case, Adam Smith's invisible hand is shunted aside, because the mercantilist shift the trade from the efficient model of Ricardo to the country that's practicing as a mercantilist. Now that's very, very critical. So if tariffs go up, certainly on the individual items, there will be a micro price increase. And that will have an impact. However, the world does not work under the assumption of ceteris paribus, all things being unequal. The world operates under the Latin phrase mutatis mutandis. Everything's moving at the same time. And so if you take an action to try to restore the Ricardian model, and we don't have the Ricardian model today. We're not even close to it. To try to move the world back toward Ricardo's ideal, and there is movement, the prices of the tariffed items go up. But immediately the foreign exchange markets are going to respond. Ricardo did not take that into consideration. So if you go back and look at the first Trump administration, immediately the dollar rallied. And that served to be an offset to the increase in tariffs. And the effect was greatly muted. And so the tariffs came on, but there was no surge in inflation. In fact, the inflation rate continued coming down. Might also add that it was very helpful that the 4-year detrended real M2 was also slowing. And so monetary policy was helping and abetting the action. So before they came in, raised the tariffs, there was a cry that we were going to get higher inflation virtually across the world. But there were offsets in the exchange rate mechanism. In addition, what you did is you moved the world off the total domination of the mercantilism. Try to move it back to the world of invisible hand. And so what's not being caught here is that when you try to correct a corrosive system and you move it in the direction of the ideal, you get a better distribution of goods and services, more efficient. And that tends to lower the cost of production. And so while there is great consternation over the increase in tariffs, in my opinion, they will not be inflationary. They will be helpful. They will improve the world. And by the way, the benefit will not just occur to the United States, because Germany has been taken advantage of by this system. So is Canada, Dave. and so have other people that have played by the rules of the game. And in addition, I think that monetary policy will stay in a neutral range. I wouldn't be using the federal funds rate to do so, but it's better than nothing. And so the monetary policy will keep things in check. Now, one final point that I want to illustrate, and that is the global economy. And it's what we have now is none of us have seen this really. You can go back and study the build up to the Great Depression and its aftermath. But not a lot of people have done that. You and I have done it, Dave and Gary. But people are not well aware of that. It was a long time ago. But so we had a situation today, which I think was of strategic importance. The European economy declined in the fourth quarter of last year. China claims they were growing at 5%, but one of their leading economists who was censored by Xi said that the true growth in China is only half of what they're reporting. So in the fourth quarter, Europe declines, even though the United States ran an absolutely horrific trade deficit, almost a record. But and what that illustrates is that the over-indebted economies around the world, with their inefficient regimes, particularly in China, but to a lesser extent in the EU as well, it indicates that the U.S. is not in a position to support the rest of the world. The rest of the world is inherently dependent upon the U.S. They're trying to sell us as much as they possibly can and achieve the highest possible trade surpluses. But even with that, in the fourth quarter, huge trade deficit here, European growth is still negative, which to me is an indication of the fact that even though the United States has these serious problems, it's still the best player. But it's not sufficiently a strong enough player to support the global economy, which means that we're going to have a long, difficult process in order to move to a better day. We can get there. There's a pathway there. It's an uncertain pathway, but it's a pathway that's there if we're able to stick to the game plan. David, I hope I didn't talk over too much.
No, that was brilliant as usual. It does trigger some questions that we'll get to later. But for now, I'm going to hand the mic over to Gary. So, Mr. Beekeeper, over to you.
Okay. All right. Okay. Anybody needs any bees, let me know. We'll send them right out. Well, if we look at the situation now, obviously there's been a huge change in investment sentiment with the election. Now, Trump is the new president, of course, for the second time. The Republicans do have control of both houses of Congress, but by very slim majorities in both cases, and not really the kind of operating control that they might like. But still, if you look at the situation, I think we're likely to see the tax cuts that were enacted by under Trump under his first term in office preserved. We're probably going to see increased government spending. That seems to be the nature of things, and deregulation. The one thing the Republicans seem hell bent to do is to remove a lot of the regulations and controls that Biden introduced. And from an investment standpoint, I think it's generally clear that the less regulation, the better it is for investments. It allows free markets to function much more clearly. Now, having said that, though, there's obviously no free lunch in this world, and that's particularly true in economics. So what are the drawbacks here? Well, it's the federal debt and deficits are definitely in that category. And what's interesting is that there has not seemed to be a lot of concern about that, despite these things continuing to mount. We've studied this in detail. As a matter of fact, our February insight, our February newsletter, and if anybody would like a copy, please let us know. You can do that either directly to us or through Dave Rosenberg. But we look at all the attempts that we've seen historically in the entire post-World War II period to control government debts and deficits, and they all been failures. And it's really been a chronic increase in government debts and deficits, not only in nominal terms, but also in relation to GDP. You got to have a denominator there to put them in perspective. And there's been only two times that has not been the case. One is early in the post-war period when you had a huge catch-up after making up for lack of spending during the Depression in the 30s and civilian spending during World War II. And then there was a brief period under Bill Clinton's presidency when you had very strong economic growth. But the only time you haven't had this chronic problem of increasing debts and deficits is when you have strong economic growth. Well, I don't think you've got that kind of prospect. There's nothing in the cards that suggests you're going to have a strong burst of economic growth unless we decide to colonize the moon or something really massive of that sort. So I think this is a chronic problem. What do you do about it? Now, of course, it's important to realize that the federal government is not the same as the private sector. And I think all too often, all of us, even including sophisticated investors, tend to look on the government and the total economy the same way they would look at their own finances. I mean, for example, people look at, they say, oh well, you can't run up debts forever. Well, that's fine, but the question is, what happens? What draws the line? What draws the line on that? And but it is true that unlike the private sector, there is no bottom line for government. There's no unless you think that the government is going to fail, there's no way that you can stop federal government from issuing debt and deficits. And of course, we have a peculiar situation in that we have the world's premier currency. The dollar is the global currency. And that means that we can abuse the hell out of this privilege, issuing debt and dollars to finance it, and the world accepts them. No other country can get away with that, and it does give us a real privilege that we don't hesitate to take advantage of. So you have a situation here where government debt and deficits continue to increase. And it's really amazing. There's the lack of concern about this in and out of Washington. But you know, what can happen here? This can't last forever. What can bring this to a halt? Well, I've got three possibilities I'll mention. One is domestic and foreign investors simply say enough is enough, that they simply do not want to accept U.S. Treasury obligations. They say, we don't want them. But that means they want something else. After all, where are people going to put savings? Where are they going to put accumulated assets? If they're not going to put them in dollars, where are they going to put them? Well, the other possibilities just are not meaningful. They're not going to put them in. The Chinese would wish they would put them in their currency. They would wish it's a global currency, but they want to control it. And the thing about international currencies is that they cannot be controlled currencies. International money flees from controlled currencies. So forget the Chinese yuan. How about the yen? Well, the Japanese don't want the yen to be a global currency. How about the euro? The euro, they got enough problems over there. And you just look at the current situation with Ukraine. That's not a candidate. Sterling, that's yesteryear's global currency. So there really isn't any alternative to the dollar. Now, another possibility is what we call a debt bomb. And this is something we've written about extensively. And what it really amounts to is this. When the government issues debt to finance its deficits, it has interest to pay on that. And the more debt, the more interest. And if we look at that and we say, okay, if what happens over time is that the more debt, the more interest, and what does this accumulate to the point that the interest, which is of course a component of a deficit, and the deficit, bear in mind, the deficit is a flow. Debt is a stock. The debt is what's outstanding. That's what you can pile up. You can count. The deficit is a flow, and the interest on the debt is part of that flow. And you say, okay, how about that? Does that get to the point that it simply explodes geometrically? And we've looked at that and studied that in detail, and that may happen, but we've never gotten there. Now, countries like Argentina, they get there routinely, but we've never gotten close. At least it's never caused a problem, so you don't really know about that. The third possibility that could cause this thing to come to a halt is inflation. But the reality now is that, and this is something that I think is more and more dawning on people, is that we are in a world of excess. We have excess capacity, and it isn't just China. China is the poster boy on this, and everybody's well aware of that. But it also is true in Europe. It's true in Japan. It's true in the U.S. We've got an excess capacity world. So yeah, sure, you could have inflation if we go out and start a war with the Chinese. Wars are always inflationary, but barring something like that, it's basically a deflationary kind of world. So this does not look like it's going to draw a halt to this. Now, this doesn't mean this thing can't continue forever, as I say, but I don't see anything in the foreseeable future which is going to draw a limit to it. And there doesn't seem to be a lot, as I say, it's what's really disturbing is the lack of concern in and out of Washington. You had some politicians 10 years ago who were very concerned about it. what happened was the voters took them home and retired them. He said, we don't care. And so there really isn't any great concern. And I think it would really take some kind of crisis. And I don't see that in the foreseeable future. There's nothing there like, there's nothing like the subprime mortgage excesses that create a big crisis, for example. So it doesn't say something won't happen, and it doesn't say the problem isn't continuing, but it to make a forecast, and some of you may know that I've made a career out of looking for hidden flaws. That's really what I specialize in, is finding things that not many other people are looking at that can cause major problems. And I've had reasonable luck in finding few over the years, and I just don't see any right now. Well, let me take that down to the forecast. Where are we? Well, we're in a situation now where in Washington there is I think a very strong orientation toward economic growth, fiscal stimulus, full speed ahead. The Fed does not seem particularly concerned about cutting things off. I think the economic growth is there. Low inflation, probably. As I mentioned, we are actually in a world of excess capacity, not only in China, which is very important. It's the second largest economy in the world, but really in the U.S. and Europe, almost every place else. So I think we're in a low inflation environment. Now, that doesn't mean that investment is really home free, because stocks are expensive. You just look at things like the price earnings ratios or price to book, any of the various measures. Stocks are very expensive right now, interest rates are they have been on a downward trend. Whether that's going to continue or not, the Fed basically seems to be saying, and we saw that as of today. They basically said, they're in no rush to cut rates further. So you may not have that push on interest rates. So I think investment is much less attractive than the economy, ironically. And so I think from an investment standpoint, you really need to be cautious. Okay, well, let me stop at that point, Dave, and I think we're going to move on to questions and comments.
Yeah. So I take it. I'll come to Gary first. So I take it that we dodged a recession in the U.S. and you don't see one coming on the horizon, correct?
No, I don't see one. Again, we've studied this in detail, written it up in our monthly newsletters, and you get two kind of patterns that relate to particularly monetary policy, and the Fed, when the Fed worries about the economy overheating, they tighten credit. Now that's what they did, a few years ago. Now, does that result in a recession? Usually it does. As a matter of fact, in the entire post-war period, by our count, we've had 14 periods of Fed squeezing, and in all but 3 of those, you've gotten recessions, because there were enough excesses that the Fed's tightening was enough to kick off these other imbalances and precipitate recessions. I don't see that now. And again, I've made a career out of looking for these hidden flaws, and I just don't see it. Oh, sure, you can conjure up something that could happen out of the blue, but I don't think there's any obvious imbalance out there.
Okay.
that suggests that.
Okay. I'm going to go to Lacy in a second, but I'm going to counter with, nobody ever sees imbalances at the peak of the economic cycle. Nobody was concerned at the peak about commercial real estate in the late 80s. Nobody, people like Warren Buffett and myself, we were laughed at in the late 90s. There was no problem. There was tremendous overcapacity.
Dave, you've seen our stuff, and we were certainly concerned about that.
I'm just not talking about you. I'm just talking about the collective we. What I'm saying is that when I talked about the housing bubble, okay, Gary, in 06 and 07, portfolio managers and CIOs would walk out of the room. So people talk about these things after the fact. We'll see how this deep sea thing plays out, but we don't know the extent. You say there's no imbalances. We don't know the extent already how much overinvestment there's been in generative AI. And not that it's not a game changer for the economy, but there's been too much investment plowed in. We may look back that we. Well, I'm just positing that as the history is to always think that there's no imbalances. Believe me, I got impaled for talking about imbalances. Nobody believed there was a housing imbalance in the mid 2000s. Until it's always written in history that there was an imbalance after all. But anyway, I'm just I said I wasn't going to interrupt. Didn't interrupt. I just wanted to just make that a little counter argument, I guess.
You're raising a good point.
There's a bubble. I think that there is a bubble. I think that there is a bubble in technology, and it was not the first time. It's not the first time that there's been deniers, and they're usually in the majority that we're not in a mania or in a bubble, and then a year or two later, then we say, oh, well, what do you know? Lacy, I want to throw it over to you. And just quickly, it seems to me as though if I'm trying to find a wedge between your view and Gary's, Gary, Gary, and this is the universal view. We were in a new cycle somehow, and we dodged a recession after the most acute tightening cycle since the early 80s. Your work is showing that the lags are not 2 years, they're 4 years. And the tightening cycle began in the winter of 2022. So I'm doing the math on that. Have you also abandoned the recession view? I can tell you that my clients and the trollers and haters that I have in social media think that I'm a total nutbar to even somehow be suggesting that it's just been delayed but not derailed. But where do you stand on that?
Okay. Well, first of all, right now, I think all of us have a serious problem in not knowing exactly where the economy is. And there are serious questions that are being raised by looking at different measures of labor market performance as calculated by the Bureau of Labor Statistics. This may seem like an arcane issue, but it's not. We have this non-farm payroll report, which it probably determines people's attitudes about the economy more than any other variable. But I have concerns that the payroll report is overstated, and probably very significantly. And we can look at two series. One is the quarterly census of employment and wages, and the other is the business employment dynamics model. These come out with a great lag. We have the QCEW for June of 2024, and we have the BEW for the second quarter of 2024. In percentage terms, the deviation between the non-farm payroll, not seasonally adjusted, and the QCEW is the greatest we've ever had in percentage terms. In other words, the non-farm payroll overshot. Just yesterday, the BLS reported the business employment dynamics. And what they showed is that the business employment dynamics is really a correction to the birth death model, which is an estimated component. And the QCEW gives you all of the other potential areas. So the BEW doesn't really address the entire problem, which the QCEW is indicating that it is even greater than the error in the birth death model. But here were the numbers. The non-farm payroll in the second quarter indicated about a 650,000 job increase from the imputed birth death model, strictly forecasted. However, the BED showed a decline of more than 160,000. In other words, there was an 800,000 miss, which was one of the deepest on records. And I noticed this morning in your commentary, Dave, that you pointed out that this has never happened unless the economy was in a recession. And the last time that we had such a deviation from the BED and the non-farm payroll, we were in a recession in the second quarter of 2020. Now, the non-farm payroll has tentacles everywhere in the national income and product accounts because they use employment to create wage and salary income, and wage and salary income then goes into total compensation, which then goes into gross domestic income. So it's quite possible that as a result of the problems with the non-farm payroll, that wage and salary income has been overstated, compensation has been overstated, gross domestic income has been overstated, which means the saving rate is even lower than it's being reported. But there's a fundamental strategic issue. If the income side is as weak as indicated by the QCEW and BED, then how can spending be as strong as is reported? And I think there's a possibility that we're looking at a survivorship bias in the retail sector. A lot of retail firms have gone out of business, and so they're being sampled, but they're picking up some business from the failing institutions. And so the data, in my opinion, is in a state of flux. And because there are huge lags in correcting the problem, we will not know for many months yet to come exactly where we were in the second half of last year. And so I think that this tremendous bureaucratic failure in the construction of the non-farm payroll raises the question of what kind of starting point that we have. And so to me, the risks of the economy are very great. And as I said, we're going to have a gap between ending the old system of fiscal policy and adopting the new one at the same time that monetary policy is still increasingly restrictive. Now, I want to say something about a point that Gary made. I think it's extremely important. The unique insight. It's so unique that Hoisington Management devoted its October letter to the capacity glut that's occurring worldwide. And I see you smiling there, Dave, because it was your team that provided us the data from the foreign countries so that we could create an aggregate level of capacity utilization for the 5 major countries that I mentioned earlier. And what is happening is that plants, factories are becoming increasingly idle all across the world. In the United States, capacity utilization is well below the long-term average, and we're well below where we entered all of the recessions, all of the cyclical recessions since 1967. I don't count the pandemic as a cyclical recession. And we then with Dave's statistics and the work that David Hoisington and I did, we created an aggregate weighted capacity utilization. We weighted it based on GDP, and we constructed this indicator. And what we found is that the global indicator in the United States are greatly linked, and that capacity utilization globally leads the unemployment rate. And that's based on testing through 2024. And so the unutilized capacity, in my opinion, is the main determinant of cost of the aggregate supply curve. And so the capacity is rising, and that suggests that the inflation rate is heading downward, and that the unemployment rate has not reached its low, and that it's going to move higher in the fashion that it always has. I also want to mention another point that Gary made concerning the United States being the reserve currency of the world. That concept, it has to be taken into consideration when looking at monetary policy, because Gary is absolutely correct. And if you view the global financial system as an inverted pyramid, the variable that's resting at the neck of that pyramid is my modern, I believe it's this modernized version of world dollar liquidity, which I've created. And it's composed of two variables. The Federal Reserve's holdings of government and agency securities, plus the foreign central bank holding of governments. And this indicator of world dollar liquidity has led all of the recessions and let us out of recessions so we contract world dollar liquidity, and then we go into recession, and then the Fed has to reverse itself. But when we shrink world dollar liquidity, as we were still doing in the fourth quarter, because we are the world central bank, we are reducing liquidity of the rest of the world. There's not only a money liquidity squeeze in the US, but it's an even more intense money liquidity squeeze out of the United States. And one of the main reasons the federal funds rate did not bring down the other rates and the extremely high consumer loan rates and the business small business loan rates is that world dollar liquidity was still contracting. And so basically the reduction in the federal funds rate was fully negated by the actions that they were taking. And so restraint is coming in at the base of the pyramid, and we're getting this long lead effect from the contraction. But if people want to look at the work we've done in creating this aggregate global capacity utilization, it's in our October letter. It's on the Hoisington website, Hoisington MGT, and you can go and take it off. But the situation in many ways has very significant deceptive contradictions to the notion that everything is hunky-dory.
Okay,
Yeah,
so with that, I want to just pose a question to Gary. We're at the top of the hour, so we have a limited amount of time left. So I want to get, if you don't mind, just a little more granular. So not a hunky-dory world, and I think both of you are in that inflation is not a problem and more likely to go down, with the world awash with excess capacity. The Fed is flying blind and not doing anything, at least over the near term. So with all that, Gary, because you're multi-strategy, multi-asset, because you also manage money, you're not just a plain vanilla economist. What's your asset mix looking like right now? Say a classic, stocks, bonds, cash. What's that looking like right now?
Well, right now, and we do manage money, and every month in our monthly newsletter we spell out our positions. But right now we're long the dollar. I think that it's a safe haven among other things. We're short commodities. Copper is my favorite short because it goes into almost anything manufactured. And if you've got excess capacity and global weakness, copper is a good way to play that on the short side. We're also short stocks. I think that stocks are way overpriced, and it's basically a risk-off portfolio. But one thing, let me just add here on this capacity issue. One of the things, if our listeners have been following what's been going on in markets lately, there's an outfit called Deep Seek, SEEK, Chinese company, and what it proves is absolutely valid historically. You go back millennia, and what it is that new technologies are always superseded by even newer technologies, and the idea that companies could rest on their laurels here, American companies in particular, then this Chinese upstart DeepSeek came along and really threw things into a cocked hat in just the last few days. And what it says is that new technologies are the crowning feature of them is they're cheaper than the existing technologies. I mean, that's what causes economic growth. That's what causes productivity growth. And so anytime anybody says, oh, well, the U.S. is in great shape, we control all the we control all the meaningful hardware and software in the world. No. You never want to believe that. And I think this is it's an important just look at what's happened to this Chinese upstart with a bunch of kids who basically have said they can do things a lot cheaper. They can for $6,000 or $8,000 produce the equivalent that took $1 billion for the U.S. to do in terms of software. So that's something to bear in mind, and it is important to our general discussion here in that it is very deflationary.
Okay, so just to wrap this last part out, long dollar, safety, short commodities and short equities, out of the risk on trade. So you missed something very important, which is actually the heart and soul of this call, which was the Treasury market. So where are you on bonds? I needed to put up a placard or something.
Dave, you're talking about my all-time favorite. I was talking about being long treasuries back in 1980.
No, but I know, but a lot of people. But hold on, Gary, just one second. I said I was going to interrupt, but I'm sure both you and Lacy, and I'm going to give Lacy last word, but I get it all the time that the secular bull market in bonds is over. The call that we've ridden for 40 years, it's done. It's a dinosaur. And I don't want to get into a debate about whether a 40-year bull market is over, because I don't think that's even helpful. But the question is, are you at this very moment bullish on the Treasury market?
Yes.
Okay. then that's okay. Now that's going to
Sure,
feed
that's
into
sure.
no. I gotta. We're 6 minutes after the hour, and I want to be respectful of the time. But that last comment, near and dear to my heart, because I certainly am bullish on bonds, and not been. I mean, through the wiggles, not been the best place to be, at least in September. But nothing moves in a straight line, and it's been all the term premium because everybody's flying blind because of the things we talked about. The uncertainty premium. If the uncertainty dissipates at some point, I imagine Treasury yields will come back down, and Jay Powell won't be walking in the dark anymore. So we finished off with Gary is likes the bond. He's James Bond, shaken but not stirred, still bullish. And Lacy, you don't do equities and commodities and all that other crap. All you do at Hoisington is you do bonds. So your big call is the duration call. So what say you at this moment?
We have very long duration, and
So, I like that. Not just long, but very long. I've got to say, from the master.
Yeah,
you and Van, the
you
masters.
can go around and check and from various sources, and you'll find the number. This is I'm here today for educational purposes only. I'm not here to advertise Hoisington Manager or promote a marketing effort at all.
No, but this is since I'm hosting the call. This comes down to my compliance department, not yours.
Okay.
You get a get a jail free card. Okay.
Okay. Thank you, Dave. Could I just add one other thing on the inflation rate? I have a good friend who's really an exceptional, knowledgeable analyst of the housing market, housing prices, demand flows, the rate structure. He knows it all. And he calculates if you would substitute a rent index based on something equivalent to core logic, which is a blend of new rents and rolling over rents, that you're overstating the current shelter costs significantly. And if you made that adjustment, the CPI year over year would be 1.8, and the PCE would be 2.2. So we have another significant problem into what actually is the true house measure, another area of bureaucratic failure, in my opinion.
I was going to say, there's something that I want to say that I think is important. And, Gary plugged Insight, which I think is first class. Gary and always has been. And Lacy at Hoisington puts out a regular report too, and is just fantastic information. So to the viewers on the call, I will be publishing something most likely tomorrow that takes you through the 2019 FOMC transcripts, which just came out. What's special about 2019 is that was the year of Trump tariff 1.0. And when you go through the transcripts, not the minutes, the transcripts of those FOMC meetings, this only took me all night. These are like 200-300 pages long. The Fed was consumed all year long with tariffs, as they're consumed with tariffs right now, and they're consumed with fiscal stimulus. But remember, in 2019, we came off the full year of the $1 trillion Trump tax cut. Now, I know that people seem to think that the Fed will never cut rates again, and the market seems to be priced for that. But I want to remind everybody that at the end of 2018, in the Fed dot plots, they were actually forecasting rate hikes 2019. The Fed was forecasting rate hikes in 2019 at the end of 2018, and instead they cut rates not once, not twice, but 3 times. And actually, after a pretty bad year in 2018, everybody right now is extrapolating the bond market and that bonds are for losers, and you can't make money in bonds. They were saying the same ridiculous things at the end of 2018. 2019 was not a year of recession, but what we found out in 2019 was that the tariffs did not cause inflation. And all the hyperventilating over the Fed that we started the year in 2019, we did not end the year with that same degree of anxiety. You read the FOMC minutes and you trace it out from January to March to June. All throughout the year, you'll see as the evidence came in as to what Lacy and Gary were talking about, the evidence came in that tariffs were not inflationary. People don't seem to realize there are three parties to the tariffs. There's the exporter, there's the importer, and then there's the consumer. And it never made its way to the consumer. And as both gentlemen said, one of the big offsets, which we're seeing already, was the strength in the US dollar, which is an inflation killer. So everybody's playing from the pre-2019 strategy that the Fed's not going to cut rates, bonds are not the place to be. But in actuality, that is a great template. The 2019 transcripts, I'll be publishing it in the next day or two, and you'll be amazed that over the year, the Fed became more concerned over growth and the tariff impact on aggregate demand than it was on inflation. And you could not have ever have guessed at the end of 2018, with all the hawkish rhetoric coming out of Powell, that they would have cut rates 3 times, and that was in advance of COVID. And the 10-year Treasury note that year generated almost a 10% total return. So I'm going to leave it there. You can call us the three. There's the three bears, but we're the three bulls. We're the three bulls. It's just on one particular asset class. And I'm encouraged, given both of your track records, that you've hung steadfast and with resolve, and not buying into this view that bonds are for losers. And so with all that, Lacy and Gary, thanks a million Treasury bonds for joining me today, sharing your thoughts, your recommendations, super valuable. Let's do it again before long. I've got to say, and I always say, the one thing that you can't replace in this business is experience. And I think between my years in the business, yours, Lacy, and certainly yours, Gary, I don't know, I think we might cover a couple of centuries. So that's experience for you.
Hey, come on, Dave. We're not
okay. Well, to health and to wealth and to prosperity and all things good for the two of you. This was actually a fantastic session, and I really do appreciate it from the bottom of my heart. For the viewers and listeners, a reminder that my next webcast will be held on Wednesday, February 12th at 4 p.m., where I will be hosting, on popular demand, Lynn Alden, who is an independent investment and macroeconomic analyst who provides research for retail and institutional investors at lynnalden.com. I have to say, over the years, because I have followed her work, she's developed a very wide following. And like the three of us here, a true out-of-the-box thinker. So until then, that concludes today's call.